Okay. Hi, Funke, can you hear me? Hello.
Hello, good afternoon.
Good afternoon, Funke. How are you today?
So, let us start. Good afternoon, everyone. Today we will be this.
Hello. So, good afternoon. I'm supposed to do this with Funke Taiwo. Funke is supposed to introduce me, but unfortunately, internet is a bit messy, and we are like 4 to 5 minutes behind schedule. So, um, my name is Mustafa Mohammed. I'm a consultant in the area of accounting, financial management, tax, and business management. I have a 9 years experience in hospitality, travels, logistics, and a host of others. I've worked with the likes of Banana Island, Private Touch Consulting, AM Shopping. AM Shopping is into e-commerce, Glaze Dental Clinic, and a host of others. So today we will be looking at risk management and investing. This is the third of our financial literacy series, where we try to educate our we try to educate people on how to be financially literate. We have a YouTube channel where you can go subscribe and watch a couple of videos that we've held or we've had as regards to financial literacy. The last one was on how to pick and analyze stock as an investor. And the one before the last one was the basics of financial literacy, that is understanding your income, saving, and then how to go on to invest whatever you must have saved. So I will implore you to go to our YouTube channel, Financial Recovery, and watch those videos, leave a comment, like, and subscribe. So, like I said, for today, we'll be looking at financial literacy, risk management, and investing. So, without taking so much of your time, let's move on and let me share my screen with you. So, financial literacy, risk management, and investing by Financial Recovery Consulting. That is the topic or what we'll be looking at today or discussing today. Table of contents, introduction, what is risk, types of risk, what is risk management and psychology, relationship between risk and returns, how to manage risks in investments. Introduction. As we all know, in today's world, there's a lot of uncertainty. And as a result of that, it seems to be a world of that is risky. Today, the stock is going up. Tomorrow, stocks are down. Most governments are borrowing to fund their capital expenditure. If they don't do it by borrowing from the World Bank or IMF, they go through individuals who they use bonds and treasury bill. So for that reason, for the world is a bit in a risky situation. So we say investing does not come without risks. Investing comes with a lot of risk. It is important to know that risks and investing go hand in hand. Hence, it is very important to be aware of inherent risks in an investment option before committing our resources into them. So because we said the world is full of uncertainty, thereby there's risks in whatever we do, then we need to try as much as possible to make sure that we identify these risks before we commit our scarce resources into whatever we are doing. Or in this case now, we are talking about investing. As an investor, to manage our risks, it is pertinent to identify, analyze, and manage so as to reduce, if not totally eliminate, the loss suffered from our investment. Yes, as an investor, it is important to identify, analyze, and manage those risks that are inherent in a particular investment before we commit our scarce resources into them. And we might not be able to eliminate the risks totally, but we can reduce them to the barest minimum, thereby leaving us with something in terms of returns now. So it is important as an investor to analyze, manage, and identify risks in any investment option we are trying to make. So what is risks? When we say what risks, we mean the likelihood of one suffering a loss as a result of uncertainty. For example, it could be low or no returns from our investments, loss of capital, health, relationship, etc. Yes, relationship, we've had a couple of stories where two people come together to invest, and at the end of the day, probably because they didn't do their findings, their research, as regards to the risks in that particular business now or that investment, both parties were not ready to take responsibility. So this could mar or affect their relationship at the end of the day. At the same time, health, yes, someone who must have lost a huge amount of money or capital invested could, as a result of that, develop high blood pressure and some other related ailments, which could lead to death, or he or she might not recover at the end of the day. Also, it is the loss incurred or suffer from investing in shares, bonds, real estate, starting a business, etc. Yes. So risks could be loss that is incurred or suffer from investing in shares, bonds, real estate, starting a business, etc. Like I earlier mentioned, we were able to look at some of these investment options in our earlier financial literacy series. So you can go to our YouTube and try to catch up on that or on them. So let's look at the types of risks. There are two categories of risks. We have systematic and unsystematic. When we say systematic risks, these are risks that are beyond the control of the investor. There's little or nothing that the investor can do as regards to these types of risks. And that is why they are referred to as systematic risks. Unlike unsystematic risks, to some extent or a large extent, the investor has a control over such risks. And that is why we are having this training on risk management, for you to be able to understand these risks and then know those ones that you can easily manage, easily identify, analyze, and reduce them to the barest minimum, if not totally eliminate them. So example of systematic risks is market risks. Yes, the market is big, but regardless, you have to own a certain share before you can say yes, you are in control. In a situation whereby you are in a market controlled by a larger company, the risk of you earning a reasonable amount of revenue to pay dividend at the end of the day, or to declare dividend at the end of the day to the investors is very, very important. Let's take, for example, the beverage industry. Coming down to Nigeria here, we used to have the Coca-Cola, we used to have the, Coca-Cola, the Nigerian breweries, and the likes. All of a sudden, we have the Biggie Cola. Biggie Cola has been able to penetrate the market. They've been able to get a certain share of the market of the beverage industry. So by so doing, it is important to know that the revenue of the likes of Coca-Cola and the Nigerian breweries will have been will have been affected. So this risk has to do with the market being diluted, the market no longer belonging to one particular company, but series or a couple of companies who now struggle to be in control. And once you're not in control of the market, it affects your revenue. Let's look at purchasing power risks. The purchasing power risk is tied to inflation. What do we mean by inflation? We say inflation is the general increase in the price level of goods and services in an economy. That is, when prices of goods and services are increasing gradually over a particular period of time, it affects the purchasing power of that particular economy as regards to the final consumers. If in a certain month, I could buy a tin of milk for 10 naira or $10, and then all of a sudden, because of inflation, I could no longer buy that particular milk for 10 naira or $10, and then it sells for 15 naira or $15, then my purchasing power has been affected if I earn $20 or 20 naira. Instead of me to be able to buy milk at $10 or 10 naira now, I'll be buying it for $15. So what do I do? So this particular risk also affects your investments. It affects whatever company you must have invested your money into, because if the final consumer purchasing power is being eroded, there's no way they can buy whatever the company you've invested into. They can buy whatever they are selling, whatever services they're providing. So for that reason, it's going to affect their revenue. And I have a reason why I keep on mentioning revenue. The revenue is, after removing your expenses, you arrive at your profits. So it is from that profit, every other shareholder or stakeholder now gets his own share, or what belongs to him or her. In the case of the creditors, they get their interest. In the case of the government gets the tax. Then in the case of the shareholders now, they get their dividend. So if the purchasing power of the final consumer is poor or is low, then it's going to be difficult to earn a reasonable revenue to meet all these obligations. Also, interest rate risks, like I earlier mentioned, one of the stakeholders in a company is a creditor. In a case where a company has gone to borrow money to expand its business because it's discovered that there's a market that is yawning or wants his or her product or service, and then he approaches the creditor, the cost of giving or getting that particular fund is what we call interest. So the risk of not being able to pay that interest is the interest rate risk. So at the time, it becomes easy when you get a lower interest rate as regards to money borrowed for expansion. But in a case where the interest rate is very high, then it's going to be a difficult situation for the company to pay dividends to its or our investors. So the next one is exchange rate risks. Yes, we don't need to go far. A typical example is the Naira. The Naira today, as of today, is 525 considering the latest CBN policy that says the BDC. So the BDC is the black market where foreign exchange is sourced for to do whatever you want to. So the new CBN policy states that the BDC have to source their FX from the bank directly. Before now, it used to be directly from the CBN, which it's based on a certain threshold that is given to the BDC. But now the CBN is saying the BDC has to go through the banks, and by the time the BDC goes through the bank, it is obvious that there will be some margin or whatever the bank will be selling to the BDC. And then when the BDC is selling to the final consumer now, in this case now, it could be a company who wants to settle a foreign creditor now, or clear his imported goods or buy goods from abroad now. He has to source from the BDC, who at the end of the day might have had a couple of or some margin to the dollar now. So all that is going to affect whatever he's going to be buying is dollar from, to make sure that he gets raw materials for production. And a company that can't get raw materials to produce its product won't be able to sell to the final consumer. So exchange rate risks or currency risks is also a systematic risk that an investor needs to also look out for. So like I said, systematic risks are risks that are beyond the control of the investor. So let's look at unsystematic risks. Unsystematic risks are risks that are within the control of the investor. Example is business risks, financial risks, political risks, investment manager risks, liquidity risks, and tax risks. In this case, the business risks there are some risks that are inherent in a particular business. So what do you do as an investor? You need to analyze this business before you go on to invest in them. You know that a particular business has, what's it called now? Has a regulatory risk, has some regulatory issue, or probably some litigation hanging around its neck. What do? You shouldn't be expected to put your hard-earned money in such a risk. It is expected that you run away from such a business. Also, financial risks. Financial risks could be a situation whereby a business is struggling to make money, to manage its cash flow or inflow. What do you do in this kind of situation? You run away from such a business after you must have done your findings or your research. Also, we also have political risks. In this case, e.g., trade barriers, taxes, legislation, and administration. Yes, a typical example is a couple of tech companies where the WESEC has asked to get some legal or some things right as regards to legislation, as regards to compliance now. So if those things are not put in place, there's a risk of that particular company not being able to function or not being able to operate. So for that reason, you have to shy away from such company, or else you could get your finger bumped. Also, investment manager risks. The investment manager risk has to do with you as an investor picking the wrong investment manager to manage your portfolio of investment. So it is important to get a very, very sound investment manager in terms of expertise and experience, so you won't suffer investment manager risk. Liquidity risks. This risk has to do with how able can you, or how fast or quick can you turn your investments into cash. how easily can you convert whatever you are you've invested into cash? And that is what we mean by liquidity risk, because it is important to have a couple of investments where you can easily turn them into cash and sort out whatever you need to do as regards to demand for money. Tax risks, yes. As an investor, you also need to look at those investment options that are tax-free and those ones that tend to be risky as regards to tax. We have a couple of them. We have bonds, treasury bills. Yes, those are tax-free investment options that you can try to put your money into. Aside from them being tax-free, they are also their income are also stable. So tax risk is a risk suffered as a result of being taxed, or your income being taxed from any form of investment option you must have made. So like I earlier said, unsystematic risks are controllable. You can still do something about them. You can still analyze, you can still manage them before you invest in the business. So let's look at what is risk management. Yes, this is the crux of our training today, or today's financial literacy. According to Investopedia, risk management is the identification, analyzing, acceptance, and mitigation of uncertainty in investment decision. This process of identifying, analyzing, accepting, and mitigating a potential risk in an investment will enable us to take the necessary actions or inactions to avoid these losses. Yes, when we say risk management, we are referring to the process of us identifying, analyzing, accepting, and mitigating of uncertainty in investment. How do we identify? We sit down, we look at this company or whatever investment option we want to invest in. We identify the risks inherent in them. We analyze them into systematic, unsystematic. Under unsystematic, we have business risks. Under systematic, we have tax risks, we have political risks. We look at those ones that we can manage. Like I earlier said, systematic risks they are uncontrollable. There's nothing we can do about them. So what do? We just have to accept them. But in the case of systematic, in the case of unsystematic now, we can still control them. So what do? We try to mitigate if we can't totally do away with them. So we reduce or we mitigate them. So risk management, like I said, it involves identification, analyzing, acceptance, and mitigation of uncertainty in investment decisions. So let's look at risk management and psychology. When we say psychology, we refer to how humans tend to react to risks. So we are trying to marry both risk management and psychology, how people tend to react to risks. In the field of behavioral finance, has contributed an important element to the risk equation, demonstrating asymmetry between how people view gains and losses. In the language of prospect theory, an area of behavioral finance introduced by Amos Tversky and Daniel Kahneman in 1971, investors exhibit loss aversion. Tversky and Kahneman documented that investors put roughly twice the weight on the pain associated with the loss than the good feeling associated with profit. Yes, these men realize that investors tend to put roughly twice the weight on the pain associated with the loss than a good feeling associated with profit, because most investors are risk averse. But what they fail to understand is that without risks, there is no returns. And there's a common saying in the investing community that the higher the risks, the higher the returns. So as an investor, it is understandable that most investors tend to be risk averse. They tend to put roughly twice the weight on the pain associated with the loss than the good feeling associated with profit. They tend to be risk averse. They try to feel, oh, what if I lose my money? Or what if I don't get these returns? So there's this fear that comes with people taking risks. So let's move to the next slide now. Relationship between risks and returns. Yes, the relationship between risks and returns is a positive correlation relationship. That is, the higher the risk, the higher the return, and vice versa. Like I earlier mentioned, it is believed in the investment community or investing community that the higher the risk, the higher the returns. So it is important to know that when the risk associated with an investment is high, then the returns from such investments will be high. Risks and returns are yin and yang of investing, intricately interwoven and inseparable. The returns investors receive represent compensation for accepting risks. So for you as an investor to take a particular risk, you're expecting to get compensated for taking that particular risk. So the returns, the dividends you get from the stocks you bought, the capital appreciation are compensations for the risk you took. The investing is not casted in stone. You don't know the outcome at the beginning. It's all about what whoever or whatever investment option you are putting your money into, what you feel it's going to give you or is going to give you as return at the end of the day that you go for or you do. So risks and returns are yin and yang of investing. They go pari passu, they go hand in hand, they can't be separated. So let's now look at how to manage risk as an investor. As an investor, managing risk is a skill one needs to understand. This will enable you to reduce, if not totally do away with losses suffer from your investment. Here are ways to manage risk. Number one, diversification. Yes, just like the common saying that you don't put all your eggs in one basket. So it is in the case of investing. You diversify. You try to analyze companies from the telecommunications to technology to health to fast-moving consumer goods, so that in case one industry or sector is being affected, you can always get indemnified. Let me use that insurance term. You can always get a bit of cover up from another sector in the case of returns now. So it is important to diversify your investments. You don't put all your eggs in one basket. You diversify your investment. Like I said, you invest in numerous stock and try to see how you can reduce or mitigate your risks. Also, we look at insurance. Yes, I purposely add insurance for those people that are going into or starting a business. For if you're starting a business, it is advisable to have an insurance policy to insure your business. By so doing, you are trying to manage your risks, if not totally eliminate it. You are managing your risks. You are trying to reduce your loss. It could be as a result of thefts. It could be as a result of fire. It could be as a result of people coming to boggle your business and or what have you. So when you buy an insurance policy for your business, you are trying to reduce or manage your risks as an investor. Because when you start a business, you're an investor. It might not, you don't have to, so the beauty of investing now has gone beyond buying shares only. You can also go through the venture capital as a venture capitalist or the PE, private equity companies that invest in companies that are not on the stock exchange. A company can also have an insurance that tries to to mitigate or reduce losses or risks that could be suffered from thefts, fire, and all what have you. Professional advice, yes. It is important as an investor to get or seek professional advice from professionals who will be able to provide you with expertise on ways to reduce your risk based on their experiences handling portfolios of other clients. So if you notice, we mentioned investment manager risk, which happens to be a type of risk under unsystematic risk now, where I mentioned getting an unqualified or inexperienced investment manager could also lead to you losing your capital returns or what have you, or investing in a risky business because you could be advised in the wrong way or giving the wrong advice. So it is important to get a professional to give you the needed advice before you go into or you invest in a particular business or company, buying stocks, bonds, real estate, ETF, or what have you. Rebalancing, yes, this involves you trying to take a critical look at your portfolio and see those stocks that are not performing, and then you can as well try to sell or reduce your risk by selling some of those stocks and using it to buy those ones that seems to be performing better. So you can do this. We have something similar to this on our YouTube channel, like I said, like I earlier mentioned at the beginning, Financial Recovery channel on YouTube. You can see how to rebalance your portfolio. So you can reduce your risk by rebalancing your portfolio. Like I said, how do you do this? You look at your portfolio, real estate, stocks, fixed income. When we say fixed income assets now, we refer to government bonds, treasury bills, corporate bonds. So you look at those ones that are not performing well, you try as much as possible to balance your portfolio by selling off those that are not performing well and trying to invest in those that are performing well. So that is what we mean by rebalancing. Then the last one on how to manage risks as an investor is stop loss order. Yes, in this case, you can always talk to your stockbrokers, your investment managers to give them a standing order where you tell them to try as much as to sell your stock when it falls below a certain threshold. Let's say you bought for $10 or 10 naira, and then it grows to 20 naira or $20, and all of a sudden you want to manage your risk. What do? You can always give a stop loss order to your investment manager to sell at a certain amount that seems to not be profitable or probably shows you are running at a loss. So the stop loss order is a standing order that an investor gives to the investment manager to see how he can reduce his risk in a situation whereby the stock is falling in value. So these are all the ways to manage risk as an investor, from diversifying your portfolio to insurance in the case of someone who is starting a business, professional advice, rebalancing, and stop loss order. In conclusion, overall, you must diversify your investment where possible to reduce your level of risk, if not totally eliminate or take away. Yes, the one that seems to be very, very easy and very effective is the diversifying of our investment. That is, we try as much as we can to see that we don't put all our eggs in one basket. We don't invest in a particular stock or we do real estate. We make sure we do real estate, we do fixed income assets or investments or stock. And in the case of stock now, you try as much as you can to do companies, industry, different sectors, just to manage and reduce your risk so that if one company, if one investment or if one company is not performing, another company will be performing. If one investment option is not performing, another investment option will be performing. So by so doing, you are reducing your risks, or if you are not totally eliminating them. However, keep in mind that systematic risk is out of your control and dependent upon the economy, while unsystematic are within your control. Yeah, like I earlier mentioned, the systematic risk is totally out of your control in the case of market risks, where you have so many competitors in the market. Not only the company you've invested in is in that market or is in that business. So there's little or nothing you can do about it. It's beyond your control. Then why unsystematic are within your control? Yes, in the case of systematic, you have business risks, you have financial risks, political risks, tax risks, which I have been able to explain in details. So this will be all for now. And like I earlier mentioned, you can go to our YouTube channel, Financial Recovery, watch our videos, subscribe, leave a comment and like, as we bring more financial literacy lectures, training to you. Thank you.